Chapter 3 is all about adjusting and adjusting entries, and it's important to know which accounts may or may not need adjusting. Cash would never be adjusted because you either get it or spend it. Accounts receivable would be the same. You either earn it or you don't. Supplies would be something that could be adjusted. So teaching supplies or any supplies could be something that could be adjusted. Prepaid insurance, again, anytime you see prepaid, that's likely to be adjustable. Prepaid rent, same. The professional library, that wouldn't be adjusted. If you bought more books, that would be a transaction, so that wouldn't be an adjustment. Accumulated depreciation, that would be an adjustment because you'd be recognizing depreciation expense. Isn't that pathetic? I can't draw a straight line with a ruler. You'd be recognizing depreciation expense, and the account linked to depreciation expense is accumulated depreciation. Equipment's the same as library, and accumulated depreciation's the same. See if I can get a straight line this time. Accounts payable, again, that would never be adjusted. Accounts payable, either you get paid or you don't get paid. Salaries payable might be an adjustment because at year end you could have a few days left over that you owe people for that you don't pay them for until the next year. Suppose your pay period ends on Friday, the year ends on Wednesday, you owe the people 3 days from last year, and then you'll pay them at the end of the second day of the new year. So that could be something that could be adjusted. Unearned, whenever you see unearned, that could always be adjustment. Because unearned means you got paid in advance for something and you're going to do the work later and get paid for it. My practice had a lot of that, where we would get paid quarterly by our large clients, but we would earn the money at ragged periods throughout the year. Common stock would not be something that would be adjusted. You either sell more or buy some back, but it wouldn't be an adjustment. Retained earnings, as you know, is the funnel we talked about, where revenue minus expense equals net income, and that goes to retained earnings. Dividends, again, wouldn't be an adjustment. You either pay them or don't pay them, declare them or don't declare them. When you see fees earned, that could be an adjustment, especially if you have unearned fees. Again, training fees earned, as long as you see fees earned, and my suspicion is that this and this will need to be adjusted. Depreciation expense, while it's not adjusted, it is recognized through an adjustment when you debit depreciation expense. Same with equipment. Salaries expense, if you have some unearned salaries payable, they would be linked, and that would be an adjustment. Insurance expense could be adjusted because you have prepaid insurance. So again, when you have prepaid something, when you use it up, it's linked to that something expense. Rent would be the same. We have prepaid rent. And that could be linked to rent expense. We have teaching supplies expense, and that's going to be linked to teaching supplies. We have advertising expense. If we had prepaid advertising, that could be an adjustable account, but we don't. So we don't need to worry about that. And the same with utilities expense. We don't have any utilities prepaid or payable, so that wouldn't be an adjusting entry. So we've identified the ones that we could adjust. Now what I'm going to do, and this is really part one, is go through and copy each of these numbers into a T account representing the ledger. Just copying the numbers over. Accounts receivable 0, 0. Unadjusted teaching supplies 8,000, 8,000. Prepaid insurance 12,000, 12,000. I'm just copying over those numbers line by line, and I always go line by line. You can't screw it up that way. And you notice I'm checking them off. Well, in this case I'm highlighting them, but I'm making sure that I'm getting each number. Professional library 35,000. I can write that in. That won't be anything we're going to adjust, but I'll write it in just for the sake of completeness. And I'm going to check it off. I got that number. Accumulated depreciation from the professional library 10,000. Professional library accumulated depreciation 10,000. Equipment 80,000. 80,000. Accumulated depreciation equipment 15,000. Accounts payable 26,000. That's not adjusted, but I want to make sure I get them all, because remember, these T accounts represent the ledger pages. Salaries payable 0. Salaries payable 0. Unearned fees 12,500. Common stock 10,000. I'm going to add that. Retained earnings 80,000. Retained earnings 80,000. Dividends 50,000. Notice I'm paying attention to the rules for debit and credit. We talked about that last chapter. Debits expenses, assets, and dividends. Tuition fees earned 123,900. 123,900. Training fees earned 40,000. 40,000. Depreciation expense 0. Coming in, that would be a 0. Depreciation expense for the equipment would be a 0. Salaries expense 50,000. Just taking the numbers from the unadjusted trial balance and carrying them over to the T accounts that represent the ledger account. Rent expense insurance expense 0. Insurance expense 0. Getting seasick from watching me go back and forth. So we got the insurance expense. We have rent expense $33,000. Rent expense $33,000. We have teaching supplies expense 0. We have advertising expense of $6,000. Debits, expenses, assets, and dividends, so it's an expense. And utility expense of $6,400. So we got that, we got that, we got that, and we're done. So we've taken all of the numbers from the unadjusted trial balance, copied them over to T accounts that represent the ledger balance. We've checked them off to make sure that we've gotten each one, and we've identified the accounts that could possibly need adjustment. Could possibly need adjustment. No promises, no guarantees.